Yeah. Surprise, a little different than you used to. Yeah. Dropping these bars on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the moe, all the Mars on deck.
All right, what's going on, everybody? Welcome. Apologies, I am like a couple of minutes late. Me being me, slightly disorganized. But we want to talk a little bit about some news that I missed like 3 or 4 days ago. It is a very, very good conversation point. And I do want to use this as an opportunity to maybe talk about the financial services compensation scheme and maybe some other things as well. Although this may not necessarily be beneficial if this did happen in terms of the coverage you would get under the financial services compensation scheme. But it's a worthy talking point in the first instance anyway. So thank you for joining me. I do have a poll. So if you wouldn't mind just adding and literally just filling in this poll, I would love to know what your thoughts are on this. And again, I should have queued this. I don't want to add an option. We are here. That's fine. Bear me 1 second, guys. Let's do that. Yes. Let's do no here. Because I'd love to get your thoughts on whether you think this is a possibility. Now, as you probably already know, we work in a system which is basically all about fractional banking. I'll do this in a second, actually, because for some reason this is not allowing me to post this now that I'm live. We work in a fractional banking system. And for those of you who don't understand what that basically means, it means that if you deposit £1 into a bank, they don't necessarily hold that pound that you deposited into this account on their balance sheet all the time. In fact, what they do is they'll lend out that pound in 4 different personal loans or by way of mortgages or whatever it might be. And that can be problematic in a situation where you pay attention to the article, which I'm going to show you in a moment, which talks about the fact that we have seen this one I should be putting up, record withdrawals in May. And the number here is actually quite interesting. Let me just share this with you so you can actually see the article that I'm actually referring to here. So this was actually from the BBC here. So it says there was 4.6 billion more withdrawn than paid into banks and building societies, according to the Bank of England. This is in May. So when you consider this, this is an indication to say that people are actually dipping into their savings accounts to cope more and more with the cost of living crisis. Now, interestingly, I had a conversation with one of my old colleagues. We used to work in an investment house together. And I actually asked her, what is she seeing at this point in time in terms of invested money in the markets? And a lot of investment houses, discretionary fund managers or investment providers have also seen, well, her one in particular has seen the highest level of outflows ever. Like, people are dipping into their investment accounts to take money out, again, to put money aside for increased bills, interest rates moving up, maybe paying off the mortgage, doing all sorts of things. It feels like there is a kind of a sentimental change between the way we see ourselves at the moment. And we can talk a little bit about what is the role of banks here, because let's be completely honest. We have seen that interest rates for mortgages have gone up quite quickly. And obviously they do, because this is the banks passing on the cost of debt. So they're not going to take that. They're not going to sit with that bag, so to speak. They're going to pass on that cost as quickly as possible. But they have come under scrutiny in the fact that they haven't been quick to pass on the increase in savings rates to consumers. In fact, interest rates have been creeping up very, very slowly, despite the fact that we've seen the interest rates be passed on to borrowers quite quickly. And this is down to how the bank does business. And I guess really profit, right? There is no getting away from the fact that capitalism is something that by all means is how we operate in Western society. And you can question whether or not it is the right thing and a sustainable system for us to continue to operate in. That's a different conversation on its own. But we know that banks aren't paying this off. And it's interesting when you see the comments here from Richard Lang, who's the Director of External Affairs at the debt charity Step Change. He said it was vital that most people are supported to build up savings to provide resilience against unexpected bills. Now, I speak to so many people from a coaching point of view where you kind of have this moment where you've done the right thing. You've done the right thing. You've budgeted effectively. You've segmented your money into the various different pots that you basically need, only to find yourself in this kind of situation right now where you build up a cushion, and that cushion may be for a house deposit. It could be for any purpose other than what you're spending that money on right now. And it's soul destroying when you find yourself through no fault of your own in a situation where you then have to utilize this money that you've worked so hard to set aside. And this is the kind of stuff that Richard Lane's really talking about here, and the fact that people need to be supported to be able to recover that savings cushion that they've built, if they have built one. I mean, we can talk extensively about people who don't even have a savings cushion. I mean, the numbers are actually quite staggering. I think it's 1 in 4 people do not have savings of £100. You know, it's really bad. And you think about how this impacts people from different social economic groups. We can be here all day talking about it. And one of my main, I guess, objectives here on the channel is to have conversations to empower people, to get people to think about the practicalities of their own personal finance. It's like the old adage goes, you better have it than not need it, than need it and not have it. And if you have got a cushion right now, everything that I've just said around the fact that you might feel as though this is not your fault and you're having to dip into that savings account, especially if you were going to use it for things like, you know, emergency fund, or it was going to go towards, I don't know, kids' university fees or holidays, family holidays, something like that. It can be a bitter pill to swallow, but it's good that you had one in the first place. How do we actually get back to getting you back in that routine where you can actually discover a little bit more? It also says here, this is the latest in a long line of warnings that more and more people are struggling to cope with the cost of living. Cost pressures are everywhere and eroding people's financial headroom, leaving them more vulnerable to harmful borrowing and problem debt. And I do want to talk a little bit about this as well, because in times like this, and I don't know if anyone's been following the Harley Davidson story, and I've been thinking about whether I should do a video on this, but it's actually quite fascinating. So obviously during COVID, people had a lot of surplus cash and people spent, right? And what's happened with Harley Davidson is that people have obviously bought a lot of Harley Davidsons and they've done that on finance. Yeah, put some deposit in, but they've now got that on finance. And Harley Davidson is in crisis right now because they have a lot of people who are defaulting and there were no debt collectors to basically go and collect the money that is owed on these Harley Davidsons that have been financed through the pandemic and stuff. So it's a really, really interesting point, and it leads very, very nicely onto what I'm talking about here in terms of harmful borrowing and problem debt. I think now it's really, really important to kind of be aware of the decisions that you're going to make. I'm doing a talk tomorrow for a business, and one of the aspects I'm going to be talking about is debt, and I'm going to talk about this here as well because it is relevant. I am fully understanding and aware that if you find yourself in a situation where things are quite tight right now, you've just realized that your mortgage payment is going to go up 200-300 quid because of the interest rate rises, your fixed deal might be coming to an end, or you might be on a standard variable rate, God forbid, or some kind of tracker. Your mortgage payments have gone up. You may be renting and the landlord's trying to pass down that increased cost to you, so your rent's gone up slightly. And if you haven't had a pay rise, you're probably feeling quite squeezed right now. And if you don't have an emergency fund or you don't have a cushion, you may be thinking, right, what are you going to do? And the reality is you have to survive. There's no doubt about that. And debt may be one of the things that you're going to be considering. And I just don't want to say, you know, don't do it, it's not worth it, because that wouldn't be real, right? That we live in the real world. You need money. And so sometimes, you know, using and calling upon things like credit cards and overdrafts are essential. They're necessary to do. But if I can give you maybe a few words just to kind of maybe help here, is please be very cognizant and patient in your decision around what debt facilities you are going to use. Try to understand that obviously with credit cards, yes, minimum payment is fine for you to make. It's not going to damage your credit score, but ultimately it's going to take you longer to pay that card off. If you're using things like overdrafts, in my opinion, and I'm only saying this because I spent so many years in an overdraft is soul destroying, even more so than the credit card, because I remember I used to be in thousands of pounds of debt in my overdraft, and it didn't matter. Like, I got to the point where I would get paid, and I wouldn't look at my statement because it didn't matter if I got paid. I was still in the minus anyway, even after I got paid, and I would just see that number build up again because I'm in an overdraft, which is more than what I get paid for on a monthly basis. So please be aware of it and the pros and cons between overdrafts, credit cards. Overdrafts, the banks have been very, very sneaky. The typical overdraft now is what, 39.9%, something like that. So if you're constantly in the overdraft, you're going to be paying hefty fees. So understanding, look, is the overdraft the best thing or is a credit card the best thing? You need to kind of understand the pros and cons of each. I would also throw into that the conversation around the importance of your credit score as well. And obviously, I talk a lot about this in my book because, and ironically, this is where my book becomes even more and more relevant now in terms of the topics that I cover there, because I've lived through a lot of this stuff that I talk about here on the channel. And when we talk about credit scores specifically, your credit score will determine what kind of credit cards you're going to be eligible for, that you're qualified for. And I talk extensively in the part of the formula which talks about credit cards specifically, about a credit score specifically, about what information goes into your credit score and how to actually go about making sure that you improve it and put your best foot forward. Now, time permitting, you may be under financial pressure. You may not have, a month or so to try and make sure that you can get your credit score improved as quickly as possible to get access to the best credit card rate available. But maybe things like the Experian Booster, they do have that thing at the moment where you can pay a little bit of money and it boosts you instantaneously for the next 30 days or within 30 days or something like that. I think is how it works. Things like that might be worthwhile considering at this point in time, especially if you're looking at things and you're thinking, okay, I need to be able to have some kind of credit facility, some kind of facility that will allow me to have a little bit of extra cash. Really important. Maybe consider that kind of stuff. But also, if you are monitoring your credit score, I did a tutorial on here about how to take your credit score. On the thumbnail, I had 0 to 814 because my credit score was 814 at the time. And I walked you guys through Clear Score and the information that goes in. And the great thing about some of these credit reference agency apps now is that it will automatically match you to, say, a credit card which you have a high propensity to be accepted for. So things like that are important, but please be very proactive and very aware that you need to know the pros and the cons of the credit facilities you are going to be applying for if you need to apply for these to give yourself some financial headroom. Look, I've been speaking to a very close friend of mine, and yes, he's got some money behind him, but he has actively and proactively gone out there to see, right, could I get a credit card with a relatively low interest rate so that if anything did happen outside of my control, I could dip into that. Now, is it the most ideal scenario? No, it's not, because ideally you want to have the financial cushion to be able to deal with it on your own. But the reality is a lot of people don't. Like I said, 1 in 4 people don't have £100 in cash. So if you're looking at these options, please know what the pros and cons of all of them are. It's really, 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 really important to make sure you're on there. I've already said that the banks are under pressure at the moment. Whether they're going to offer new interest rates or not, we don't really know. I mean, improved interest rates, we don't really know. But I did see that this graph was very, very interesting. I'm just going to show this to you because it is indicative of what's going on right now. So if you look at this graph, this is savings withdrawals. Look at this. I mean, it's huge. If you look at that fall right there, is absolutely massive. That is the depth of what we're facing right now. Now, how does this come back to possible run on the banks? And I can't get the poll up for some reason it's really annoying, but please let me know in the comments. This is the question. Do you think that we would see a run on the banks if the cost of living continues to increase and we continue to see increase in interest rates, increase in mortgages, and potential rent payments as well? Just respond yes or no in the comments because I'll be interested to get your take on this. Now, a bank run is very, very scary. I mean, the last one I can remember is probably Northern Rock, okay? So a bank run is essentially when everyone tries to mass withdraw from a bank because they feel as though they need their money or their money is at risk. They're not going to be able to get their money back. Our fractional banking system is problematic in scenarios where we have seen that 4.6 billion quid more is being withdrawn than what's been paid in. It is a problem, because the reality is that if we get to the point where interest rates do increase quite significantly from where they are right now, if more people need to withdraw cash, the question is, do they have the money available? If you go into a bank right now and you said, I need to take out 50 grand, they'll probably tell you to come back in 3 to 4 days' time, because they don't have 50 grand lying around, and they definitely couldn't give you as one customer 50 grand. I remember when I was a cashier in a bank, we used to have obviously the money guys deliver the money on a weekly basis. There would only be a certain amount in there, and that money would be for the cash till obviously transactions and to fill up the cash machines as well. So a bank isn't going to have 50 grand available to you, or even £20,000 that you could withdraw cash just like that. And that's where the fractional banking system becomes really problematic. If people really wanted to access cash, really wanted to get hold of their money in cash form, they probably wouldn't be able to get it. Well, they wouldn't be able to get it without having to wait 2 or 3 days. And for many people, that is really, really scary. And I think it is worthwhile speaking about, the financial services compensation scheme, what it does and what it does not cover, because this is really, really important. A lot of people assume that the financial services compensation scheme, which is essentially the scheme that where if you have money deposited in a bank or a building society, you're covered up to £85,000 of your deposits. Now, the coverage for the financial services compensation scheme is if the company goes bust, so they're unable to operate due to, I don't know, mismanagement, something like that, right? The bank just simply can't operate anymore. It does not cover runs on a bank. But it is worthwhile speaking about what you do get coverage for under the financial services compensation scheme, because people often ask a lot of questions around this. So let's just jump over to this one right here. Now, it is worthwhile just noting that the financial services compensation scheme is actually provided for banks that are regulated under the Prudential Regulation Authority. And it is probably worthwhile just going through what that basically means, because a lot of people will... let's do this quickly. 1 second, guys. Sorry. A lot of people will talk about the FCA, which is the Financial Conduct Authority, but there are two regulatory bodies in the UK. You got the FCA and you got the Prudential Regulatory Authority. Now, the Prudential Regulation Authority is part of the Bank of England, and they basically regulate financial services bodies essentially. So these are their three objectives. Their three objectives are to promote the safety and soundness of the firms we regulate, so banks, building societies, investment houses, so on and so forth, to contribute to securing an appropriate degree of protection for insurance policyholders, and facilitate effective competition between the firms. That's what they're there for. Those are their three objectives. Now, it says here, as part of the Bank of England, we're responsible for the prudential regulation and supervision of around 1,500 banks, building societies, credit unions, insurers, and major investment firms. That's what they're there to do. So under this, they have the Financial Services Compensation Scheme, which is something that all of the banks, building societies, insurers, all of the investment houses basically contribute to. They pay a levy every single year to be part and to have this protection in place for you, the consumer. But as you, the consumer, you get £85,000 worth of coverage. Again, if the company goes bust, not if there's a run on the banks. And so whilst some of my talking points and some of my advice here will be, look, if you are worried about potentially where your money is sat right now, and let's just say you're sitting on quite a bit of cash, you're sitting on over £85,000, then probably what you want to do is you want to start spreading your money across different providers. And that is identically the same if you've got money invested where you're over that £85,000 limit. Now, obviously, you need to be selective when it comes to the kind of companies that you use. Preferably, you want to use one that has been around for a long time. On the investment front, has a lot of money under management, quite a large customer base. From a bank's point of view, you probably want to have, again, one that's got a large customer base because they're likely to have better financial resources. We're not back in 2007 and 2008 where, they had very, very little solvency. The rules and regulations that were brought in after the 2007, 2008 crisis basically meant that they need to have more solvency than they did back then and they get stress tested all the time. So you can have a little bit of confidence in it, but that isn't to say that you should be, I guess, negligent of the fact that, you want to make sure that you have sufficient protection in place. So let's just run through, and I'll post these links down in the comments below, because it is worthwhile you perusing through this if you are the kind of person who is kind of a little bit jittery about this kind of stuff, and perhaps you just want to know the details. You want the peace of mind in knowing the details, so you know that you're going to be okay every night when you go to bed. So let me just bring this screen up here. So it just says here, look, what is a financial services compensation scheme? It will pay compensation to customers of authorized financial services firms when they fail. It's set up by Parliament, funded by the financial services industry. The FCA is a completely independent and free service. Now, if you're an individual, you have £85,000 in total coverage. So that is, from my understanding, and I think it's in the Q&A section here, which we'll come to in a moment, it is regardless of whether you have 2 or 3 accounts. That's the total coverage you can have, £85,000. Now, if you have joint holders, it says here, yes, you still get protection on the financial service compensation scheme, up to £85,000 in total across all accounts you hold in your name, or where you are listed as the beneficiary. So you might have a trust, for example. If you're beneficiary of a trust, it's also going to include that as well. If you have a company, there are some bits and pieces here that you should also know. If you're a sole trader and you're trading under your own name as a sole trader, the coverage is 85k. If you have a limited company, well, your limited company is essentially treated as a separate entity. So you'll get 85k coverage from a business point of view of £85,000, and also the personal coverage of £85,000 as well. There are some really, really good points here that I've just listed that are worthwhile going through if you are really interested in understanding how this works thoroughly. I will put this in the links after this live as basically included. But look, are we going to see a run on the bank? I'm curious to see what you guys actually said. So bear me 1 second. Let me just get rid of this and come back full screen. Let's see what you guys have said in the comments actually on this. Where are we? There are some yeses in here. There's about 3 yeses, 4 yeses in here. There is a no on here as well. There's a yes. There's 2 no's. I've seen 2 yeses at the moment. No, there are 2 no's. I've seen about 6 yeses altogether. 3 no's. Let's just run through these comments very quickly, because it'll be interesting to hear what you guys are actually saying and kind of gauge the sentiment that everyone's feeling at this point in time. And let me know, guys. Look, there are about 92 of us on here at the moment. It will be great. There's only 17 likes. It takes 1 second for you to do that, but it means that after this live is concluded, just means that YouTube will recommend this to other people who might actually benefit from this conversation. So if you could smash that like button for me, that will be absolutely amazing. I'm just going to switch over a few things right here now, so we can actually look at some of the comments that we have in here, and maybe have a brief discussion of around what you guys actually think. So let's go right to the top here. And see what you guys are saying. Lee is saying here, I'd love to see a run on all major banks. They lend out our money, make massive profits, and give little back. Yeah, I mean, look, I come from the industry, so my views are slightly different. And I guess maybe some people will disagree with me, and that's completely fine. But what I think people often miss is the fact that banks are businesses at the end of the day. That is what you sign up to when you give your money to the bank. That's how the system works. You give them £1, they lend that money out, they use that to make profits, but they also use that to obviously hire people. And it is so entwined into our economy and into our way of life that it's very, very hard to separate banking, financial services from industry. We spoke yesterday about whether or not supermarkets should provide a price cap, and many people said no, they shouldn't, because at the end of the day they are a business, right? You can't expect business to detriment their own profits for the good of everyone, not in a capitalist society. And this is why I said at the beginning of this that this is the issue with capitalism, right? Because it is for profit, it is for the benefit of business and for profit, right? In another system, maybe you could argue that it could be sustainable. You could find a way to make it work, but you can't expect businesses to sacrifice their profits. In the banking sector specifically, and it is worthwhile speaking about this, the financial services sector is one of the largest contributors to our economy as a whole. So if, say, for example, like, one of the Labour MPs said a couple of weeks ago, you should force the banks to basically, help people out with their mortgages. Well, if they did that, and let's just say they were able to do it because they ignored their shareholders, and their shareholders are problematic, right? Because you may think that the shareholders are billionaires, trillionaires, millionaires, and you'll be right to a certain extent, but actually their shareholders are anyone who has a pension. So that will be you. If you have a workplace pension, you are a shareholder in your you are going to be reliant on the profits of the banks to provide you a pension income at some point. So you're an indirect shareholder, really. Your mum, uncles, aunts, grandparents, if you have parents, grandparents who are retired, who are drawing a pension, they are reliant on the profits of banks to be able to have an income. And you may be questioning to what degree. Well, that depends on the investment portfolio, what their exposure is to the financial services sector. But if you look at it from that point of view, you say, well, actually, they've got to answer to their shareholders. How would you feel if you're drawing income from your pension and you hear that the bank that you're invested in, which gives you part of your pension income, is now sacrificing or putting at detriment their profits, which could impact your pension income? It's so intertwined. And even if you did say, okay, the shareholders are completely fine with it, okay, the banks did help people and their profits basically suffered. Well, what then happens is business decisions start to kick in, redundancies start to happen. And when redundancies start to happen, people potentially lose their properties. That could impact the property market. It is such an intertwined cycle that is so hard to separate out. And if we see the financial services industry suffer, our economy suffers as well. And when our economy suffers, that means jobs. It's so intertwined. It's really, really hard. But I get your sentiment because, people will always refer to 2007, 2008 for the bailout that happened back then. But you have to ask yourself what happened. What would have happened if we didn't bail out the banks? Businesses would go under. Because guess what? Businesses use the service of banks for their banking facilities. If the bank is gone, and let's just say they have a line of credit, or all of their money is being borrowed for projects, for building homes, right? For building office blocks, for building everything that you could think of, right? That we live with in our society is funded through money, which is provided through these banks. So if we let them fail back in 2007, 2008, the fallout would have been catastrophic. It would have changed the world as we know it. And that's where the phrase too big to fail comes from. They are too big to fail, essentially. And it's very, very unpalatable to kind of, to use that phrase, but it is the truth. And it feels as though it's a thorn in the side that you're never going to be able to get rid of, because what are you going to do about these banks? It's such a difficult thing. It really, really is. Lucan's just saying, is it just me? Do you have a scheduled live talking about a bank in which there is no overpayment limit? Yes, there is. That's going to be on Thursday. So I'm going to be breaking down what that offer basically is. I spoke to them today on the phone. I'll be showing you a few bits and pieces there. But I think it will be very, very topical for people who are in this conversation at the moment about overpaying their mortgage. It's really, really good. And I'm not going to take 100% credit for this. There was a comment in the last video that we did on mortgages that basically said this bank does this, and I went and found out more. So that's going to be Thursday at 6 p.m. So hopefully see you there. Rogue is saying here, I think it's a real possibility of a bank run occurring. I think things would have to get really, really bad, like really, really bad, for people to be that panicked to be able to move money out. But look, if inflation continues to soar, interest rates go up, mortgage payments soar, rent increases soar. The boss of British Gas was talking about energy prices are going to be higher for longer. I mean, the wholesale price of gas and energy has fallen. I haven't read that article just yet. I was thinking of doing a video on it. If you think it's a good idea, I will do a video and maybe, provide a little bit of insight to that. But if we see that everything increasing, I can see a scenario where it could be possible. I hope it doesn't happen personally. I hope it doesn't happen, because it will be horrible if it did. You'll find that a lot of people who will be it will be scary. if it did. I mean, even from a personal point of view, thinking of where I hold my emergency fund, the thought that there'll be a run on the bank and that could potentially, destroy everything, and I wouldn't be able to get hold of my cash. That's quite unnerving. So I hope it doesn't happen, but I could definitely see a scenario where it could happen, which is why it's so important to pay attention to the news, what's going on, so you can kind of keep your pulse, your finger on the pulse of things, so you can kind of make informed decisions around what might be coming around the corner. I always say that it's better to have an inkling of something so you can prepare than not have any clue, then be confronted with this thing that is such a surprise, and you're just blindsided with no options, nothing to do. And so that's why I've been doing more lives recently and having these kind of conversations, because I think there's a lot that's in my head that I know, which I think is just normal, but having these conversations out loud hopefully adds value to you guys, so that you can take some of this away, you can do some further research, and you can use that to kind of inform your own personal decisions when the time is right for you to make a decision. So I hope it doesn't happen, but let's see. Someone's just saying here, the facts amount is too low. Sorry, the FCF's, the Financial Services Compensation Scheme amount is too low. To be honest, it's been the same for a long time. Should they increase it? I don't know. Would that be palatable? The question is, would it be palatable for the financial services industry, companies that pay into this, that pay the levy for it? There could be an argument to increase it, I guess. I don't know. £85,000 is a lot, but it is relative, to be honest. If you got 150k or 200,000, 300, 400,000, a million quid investment portfolio, at that realm, I remember sitting down with clients when I was advising or working for discretionary fund managers, where we'd be talking sizable amounts of money, and this topic would come up. And it's like, well, if this is a big concern to you, you're kind of scuppered, really, because it means that you have to make the impossible choice of spreading all of this money across so many organizations that the goal that you're thriving for becomes impossible to achieve, because you're not pooling your money into one thing. You're spreading it across multiple providers that are difficult to manage, different pricing structures, charging structures, different investment setups and structures. It's impossible to manage. And so the conversations used to be, well, look, we do due diligence on the companies that we work with. So we work with companies that have a lot of money under management, the vanguards of this world, the big investment houses who will have real big liquidity pools of cash set aside for these kind of things. Is your investment held in a separate account, in client accounts, which isn't mixed up with the company's money? That's also very, very important. Something that, if you look back to FTX, they didn't have that, right? They didn't have client money in a separate account. The money was all in the business account, and they were using that business account for whatever it is they were doing with customer money. Being regulated really helps in that kind of conversation, because the regulation is what requires these companies to have these things, have these requirements in place. And so, yeah, it is too low when you're looking at that high levels. But some people say £85,000 is quite a lot. I'm kind of in that position where it's kind of like, well, it is a little low, but what does it need to go up to? And if you do increase it, where's the ceiling? Where do you say, okay, it's going to be capped at right here? But yeah, look, it's a really good point, though, and it's a really good conversation piece as well. Lisa's saying, if you think the interest rates will go down in a couple of years, then move your mortgage to interest only, short-term fix. Potentially, yeah. I mean, that's something that I definitely suggested. I was on Sky News and I said this was something that is an option. But I said with the caveat of just being aware that obviously you're only paying your interest only for that 2-year period, and being aware that you need to get it back onto a full repayment. Psychologically, this is what I've seen happen with clients when I've worked with them as a mortgage, because I'm qualified as a mortgage advisor and qualified as a financial advisor. So I used to do investment advice, pension advice, and I used to do mortgage advice as well. And I've seen circumstances where clients would, go onto an interest only, but then you see them 6-7 years later on. And I spoke to 2 people over the last 2.5 months in this exact same position. 2 people, they got to the age of 64 and 65 respectively, these 2, and they're both ladies as well. Get in their statement, your mortgage is coming to an end, you owe us X. And they're looking at it thinking, what? How? And then I get the documents over and I say, it's because you've been paying the interest on the mortgage all this time, and they moved to interest only for this same kind of scenario. Oh, we needed a little bit of respite to reorganize our finances, and they never got back round to getting it back onto a full repayment mortgage. And psychologically, what tends to happen is, as human beings, we become more accustomed to the lower rate, the lower expense, and we don't increase it again. And that's what happened in those two instances. So it is a great suggestion, but with the caveat of knowing, look, you're going to have to make sure that you definitely go on to a full repayment. Put it in a diary, or get it in with a mortgage broker or whoever to do a reminder, just a note. Put it on your phone to say, look, move interest only back to full repayment. But it's a really, really good suggestion to give that little bit of respite. Lee's also just saying here, why not pay off debts with a credit card, then move it to another one with 0% finance? Yes, from debt strategies, yeah, that would definitely work. The danger that you have there, and I look, I can only speak from my own personal experience. I've been in that cycle where you transfer from 0% balance transfer to 0% balance transfer. What people tend to, well, I'll speak for myself. What I did is I will just make the minimum payment, or maybe pay a little bit over on some months and not on other months, but I still have that balance available. And then sometimes, because life happens during the course of that balance transfer, I use the card again. And therefore, you've paid it down, but you've added more to it, and it's a vicious cycle. So with things like credit cards, and I talk about this in my book, and if you can scan the QR code, which is right there in the corner, I talk about the fact that if you are in credit card debt specifically, you need to have a plan of how you're going to go about paying it down within the window of the 0% balance transfer. And it is going to take a little bit of discipline. It is going to mean that you've got a budget. You've got to really be focused on how you're going to do that. And you're probably going to have to make some sacrifices. But once it's gone, the weight that comes off your shoulders, believe me, is, oh my God, you feel like a new person because it's not there. And for me, psychologically, it was always in the back of my mind. I've got this overdraft, I've got this credit card, and it's soul destroying. It's so depressing. And it just got to the point where it's like, I've got to do something about it. I have to do something about it. And it's scary to confront it. It's scary to admit that maybe you've made some mistakes. It is. But I found that the sooner that I did that, I felt more in control. I felt more kind of like empowered, like, okay, I can do this. I've got a plan. I can do this. It's going to take a little bit of hard work. It's going to be a little bit painful. I've got to sacrifice a few things, but I can do this. And I can see the light at the end of the tunnel. And the beautiful thing is, the minute you start getting into that cycle of implementing that plan, and you're making progress, and you can see that the balance is dropping, and you're not adding more to the card. And one thing I share in the book is, cut up the card if you can, or just put it in a drawer. Don't carry it with you. Don't give yourself the temptation. When you see the balance falling, you start to get this real, like, inner feeling where you want to do more to clear it off. And it's quite magical when it happens, really, but it's tough to get to that point. So for sure. What's Rogue saying here? Okay, so these are the responses to the question of whether or not we would see a bank run, if we could see a bank run. Someone's just saying here that no, people would really have cash left to withdraw. Do people really have cash left to withdraw? Good point. Some people don't necessarily have any extra cash to withdraw potentially, but for those people who do, it may be a bit of a scary thought. Matt's here saying, no, I think if a bank run happens, we could have the ability to bail them out, so the government will do whatever they can to stop that. That's a really good point, actually. You know what would happen? I mean, we did see this in the States, maybe 3 months ago with what was it, Silicon Valley Bank, and a couple of other banks after that. The US government stepped in and basically said, look, we're going to stop withdrawals now. And they stepped in, and then one of them was sold on to another thing. So if we did see that, I would be very, very surprised if the government didn't step in very, very early doors to be like, listen, we need to curb this, and these are the provisions that we will make. So that's a really good point, mate. Really, really great point. But Luke, mate, it's Lee. Listen, it's not the banks that would suffer. Like, I really do think that people think of banks being these group of peoples. When you're thinking of a bank, you might be thinking of the CEOs on 1, 2, 3, 4 million quid a year. Those are not the people who are going to suffer. The people who are going to suffer are the ones who have bank accounts, who have mortgages, the companies that use them as a business facility, their customers, anyone who is invested or a shareholder in the bank, i.e., pension funds, your workplace pension, your uncle, your aunt's, your mum's, your dad's pension. Like, those are the people who are suffering. Like, we need to get rid of this idea that the bank is a multi-billionaire, an individual, or a set of individuals. It's far beyond that. If they won't suffer, they'll be fine. Most of the guys at the very, very top echelons of financial services, and believe me, I know, because I've worked in Canary Wharf, so I know where they are at. A lot of these guys, they are rewarded very handsomely. A lot of them in shares as well, so it's connected to the performance of the bank, so they have that incentive. And many people will frown upon that. I think that's actually a good thing. It means that if they do anything that detriments the bank, or anything from a business practice where the bank loses money, their remuneration essentially gets impacted as well, because it's tied to the share price and the performance of the bank. Because some people think you shouldn't have that, but I think you need to have some incentives, and that's a completely different discussion. But those guys at the top, they're not the ones who are going to suffer. You say, let them suffer. We will suffer. Customers, mortgage holders, savers, people who deposit, use their services. Those are the people who are going to suffer, not the head honchos at the top. They're insulated. Yeah, they might lose their jobs. They may not get paid, $1 million a quid or two for a year. They might get docked some pay. But trust me, these guys, they've got pension funds, they've got cash lying around, they've got properties, they're sweet. Like, they're not going to suffer. We suffer. What would you like the banks to what would you like the banks to pass you? That's a good question as well. That's a conversation that's going on there. Interest on savings would be nice. Yes, more interest in more on increasing, at least passing on the interest rate rises quicker would be nice, for sure. I'm due to do maybe like a video where we talk a little bit about maybe some of the best interest rate savings accounts out at the moment. But we're seeing that people are withdrawing money quite quickly because they need access to it. And I think when you think about the government speaking to the banks about this, they're trying to basically, because this is the cycle that tends to happen. And when you think about inflation, what is it all about? They increase interest rates to encourage people to save more, right? So when you save more, you spend less, you bring down the cost of goods and services around you. Now, when the banks don't pass on the savings rates quickly enough to make it more attractive for people to save, this is what happens. People take money out. So all of that money that's been taken out, that is going to end up in the system, which could indirectly be inflationary. It's a really messed up cycle when you think about it. And it's quite a complex cycle as well. So when Jeremy Hunt and Rishi Sunak having meetings with banks saying, look, you need to be passing on these interest rates a little bit quicker, because the bank rate's gone up, you need to get it to your savers so that they can benefit. All they're trying to do is say, guys, help us out here. If you give better interest rates, maybe people will save more. They'll be more inclined to put money into a savings account and leave it there, taking money out of the system. That then helps inflation. You would think everyone's singing from the same hymn sheet, right? But hey, this is where it's frustrating, right? Business does one thing, government does one thing, Bank of England does one thing, and then all of us are here thinking, what's going on? How do we make sense of this? And you would think that everyone would be talking to each other, but they're independent entities. The Bank of England independent to the government. The business is an independent entity, should not be dictated to what they should do or what they should be doing by the government. Yes, you can introduce regulation and rules and all this kind of stuff, but the government can't say you need to do this, because what's the point in having a business then, right? It is so messed up right now, and it leads to such fascinating conversations. But look, it's a very, very difficult situation at the moment. I'm just scanning through some of these, some of the comments on here. Let's have a look. Aston's just saying here, doesn't NSNI cover all of your money? Could you comment? Well, £50,000 is the maximum you can have into NSNI premium bonds. It is safe as you could probably get, really, to be honest, um, because it's government, it's a government thing, isn't it? Really, at the end of the day, so it's pretty safe. It's pretty safe. But the maximum you can have in there is 50 grand. 50 grand is the max. All right. So James is asking here: 10,000 in the bank. Is it worth taking out and sticking in my safe to be sure? Mate, listen, listen. I can't really comment. Look, at the end of the day, I can speak for myself. Am I worried about the cash that I have in an account right now? No, I'm not. And I don't think there's any real cause for concern at this point in time. I just don't think there is. I think the best thing you can do is, like I've already said before, pay attention to what's going on in the news. If interest rates continue to rise, you have to think about what's going to cause it. What would cause it is inflation goes mad, which we're actively trying to work towards reducing. So pay attention to all of the news around inflation, interest rates. That's going to be another lever as well. So as long as you're kind of up to date with what's going on there, I think you should be in a position where you can make an educated call. But I'm not worried at this stage, personally. I'm not worried at this stage, and I don't think anyone should be worried at this stage. But things can change rapidly. But like I said, for there to be a run on the banks, things would have to get significantly worse than what it is right now. And I'm hoping, like I've already said on a number of lives, I'm hoping that the government get it right. And I don't care whether it's Tory or Labour or Lib Dem or Green Party, whoever, they could put an Oompa Loompa in there at the moment. I hope that Oompa Loompa gets it right. Because if they get it right, we win. The sad thing is, and again, speaking to, I've caught up with a lot of my old former colleagues who work in the investment world, and they have access to research teams and economists and stuff, and none of them are spouting any good news. None of them. Like everyone's just like, this is bad. Like this is going to get horrible, and it could get horrible very, very quickly. And so, look, it's not like we haven't been here before. We've been here before, but many people have experienced it in a different way now. Back in 2007, 2008, I know that a lot of followers here may have only been in university, coming out of university at that point. You've now grown to the point where now you're probably thinking about house purchases and family and all this kind of stuff. So you're seeing this from a very, very different point of view, because it's directly impacting you now. And it just means that we've got to be smarter with our decisions. We've got to be smarter with the way that we look at the world. And we need to put on our big girl, big boy pants and think about things and take actions properly as adults. And we need to understand, importantly, crucially, and I'm going to do a plug here, because I've been working away in the background, and I'm going to be doing a video on this at some point. We need to understand, I've been speaking about this so much over the last month or two, because I've done a lot of corporate talks on well-being and stuff, financial well-being. We need to tune in to our behavioral triggers that make us make poor financial decisions, or don't quite make us as confident in the decisions that we make, in our capability and our competency when it comes to money. We don't get taught any of this stuff in school, right? Everyone will agree with that. MPs in parliament agree with that. Anyone I speak to agrees with that idea. We do not get taught this in school. And therefore, as adults, as we try and feel out the world, as we try to make the best decisions through trial and error, because guess what? We weren't taught it. So we'll try something, see if it works. And if it works, great. If it doesn't, we deal with the consequences. But behind all of that, and you read my book, I share the two instances that really, and I'm gonna use colorful language here because it's warranted. It really fucked me up. And I didn't understand this until much, 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 much later. Mindset. What are the things that you observe when you're 6, 7, 5 years old? Because study tell us that, we form our financial habits at age 7. And in my book, I talk about the two instances of the things that I noticed when I was 1 at 5, and actually 1 around about 8-ish, 8, 9-ish, that really, really ingrained a scarcity mindset, which meant that when I got to Canary Wharf and I was doing really, really well, I made all the wrong moves. And it wasn't until years later when I'm like, how am I broke every month? I'm doing all right. It's not like I'm not earning good money. I'm actually doing okay, but I'm broke every month and I don't know how. And it comes down to frivolous spending. It comes down to habits those routines that we've subconsciously just settled into, and it's second nature. And we need to kind of understand that. We need to make conscious efforts to try and understand this, the wiring in our brain, that subconscious behaviors that trigger us to do certain things. Because we can talk about budgeting, we can talk about avoiding debt, we can talk about investing and make sure you have an emergency fund and understanding what your credit score is. We can talk about that until the cows come home. If you don't get underneath, right, why do I make the decisions that I do? What is my makeup psychologically, behaviorally? You're fighting a losing battle. It's like just pulling up weeds without really attacking the roots. And so I've been working on a lot of behavioral assessments over the past month and a half, and I'll link a couple of them in the comments down below. Go and have a look. They're not free. They're $11.99, so it's $9.99 plus VAT because I'm VAT registered. But what they basically do is they take you through a series of questions. So there's a money personality test in there. There is what else have we got? There's 4 at the moment. There's a money personality test in there. There is a self-efficacy test in there, which is your competency when it comes to making financial decisions, so on and so forth. There is one on spending habits, right? Spending habits. So what are your triggers to you spending as you do currently, and how do you identify what they are and how do you address them? What are the recommendations for it? So you get a score based on all of the assessments that are there, and it gives you recommendations. And it's a really nice piece of work to help you understand the behavioral patterns, and by answering the questions you'll get a glimpse into, okay, maybe I need to pay attention to that, because that's what I had to do. And I didn't have an assessment to take at the time. I had to journal. I had to think, right, this is messed up. How am I getting paid this much, but I've got 0 at the end of the month? And it happens every month, and I found myself stressed out. So I really had to journal, think about, who am I with? What happens when I spend money? Am I at a certain place? Am I around certain people? Is it a certain time of the month? Do I feel a certain way when I go and act out and go and spend and go and buy these things that I don't really need? I had to journal all of that. And then I had to recognize, okay, right, these are the triggers. What can I do to mitigate it? And I didn't have an assessment. I had to do it on my own. So the assessment is kind of like a fast track to that entire process. Questions to probe, questions to get you to think, and it comes up with a score and recommendation. So I'll link a couple of those in the comments down below. But I think, look, I cannot stress this enough, mate. Guys, it is so important. If you can get behind this, like the wiring, the behavioral things that are going on that trigger the habits, that trigger the things that you do, you'll be so much better off, like really so much better off. And you'll feel like you understand yourself and the decisions that you make a lot better. Well, I'm slightly conscious of time because we're coming up to about an hour right now, and there's 115 of you here. Thank you so much, by the way, guys. Like, I wasn't sure whether I was going to do this or not, and normally I do like recorded videos, right? I just enjoy this a little bit more. I enjoy going through the comments and interacting with you guys. And when you guys stick around like this and you interact, and you have conversations in the chat, it makes all of this worthwhile for me. And I really do appreciate every single one of you. Thank you. So let's see if I can get through a few more. There are quite a few comments. There's quite a few comments in here. I'll try and get through as many as I possibly can. Let me just find where I was. Someone just saying here, fractional reserve lending, the gift that keeps on giving. Yes. I mean, this is where it becomes really problematic. Look, do we need a hard stop and a restart? I think most people, when you really think about how messed up the system is, will say that we do. It's just how they do that, I don't know. I mean, central bank CBDCs are probably how they're going to do it. How it's going to work practically and technically, I don't know. But that for me represents this is all messed up. We need to start again, press the button overnight, and hopefully there's no blood in the streets and no one's gone mad. But look, the system just does not work right now. It's just really messed up, and it's not sustainable. It just really isn't. Someone's just saying here on CBDCs as well, bank failures only strengthen their argument for a CBDC. 100%. The scary thing is that the whole idea of it being programmable and then being able to control what you spend money on. I mean, that right there, that is pretty scary. And as much as I come from the financial services industry, I would like to think that I have a healthy amount of trust, but also a healthy amount of distrust in their intentions. Because I'm not I'm not foolish enough to think that this is all rosy, that the world is fantastic. It's not. It's pretty messed up. And people do pretty messed up things to get ahead. That's just what happens. And as much as you might try and regulate it and hope that people will do the best thing for customers and do the best thing for business, there are those people who are just out to get it. They're out to get the bag, and they don't give a crap what happens to anybody else. And I've seen instances where greed gets the better of people, and they don't care. And the sad thing is, we see this a lot in scam culture, right? Spoke about Cash FX 2 years ago, got a ton of abuse for that. And even when I jumped into these groups to be like, guys, you're setting this stuff, you're trying to recruit 13, 14-year-old kids into a crypto trading scheme. They're not even old enough to do this. The argument that they give, and I've seen this so many times with people that I've met through the industry in 15 years, I'm just trying to feed my family. Like, that's not a good enough excuse. It's a really, really messed up world. But you're right. If we see bank failures, it's just going to bolster the argument for CBDCs, and it's going to give them the green light to do it. I think it's going to happen anyway, uh, regardless of whether we like it or not, because the system just isn't sustainable. It's just really messed up right now. Very excited. Lots of great investment opportunities to be had if we see some banking disasters. Now, this is the stuff that I haven't really been talking about on the channel. Look, whilst we are saying that this is horrible and this is terrible, there are investment opportunities here as well. I've not really spoken a lot about them because it feels like the the interest rate, the mortgage rate thing, certainly from a YouTube search engine point of view, is definitely getting more traction. It feels like it's what is most worrying people. I've certainly found that when I've spoken about investment, there isn't that much interest in it. And so I want to be able to provide the value and the information that you guys want, but there will definitely be lots of opportunities as well. There's a nice conversation going on between some people here, Arwin and James. Let me just have a little scan through here. Please, yes, please do smash the like button. There's still 116 of us here, but there's only 51 likes right now. It takes 1 second for you to do it. If we can get it up to 80, it just means that when this is said and done, the YouTube algorithm thinks, oh, people enjoyed that, and then they just go recommend it to other people, and other people get to benefit from this conversation as well. So please do that for me. It will be much, much appreciated. David is saying here, the system mainly runs on trust. If people don't trust, then yes, there may be a run. But if the system is really that bad, then there could be some sort of bail-ins. David, I would agree with you on that as well, for sure, 100%. I mean, everything's based on trust. The minute there is trust lost, my money isn't safe. That's the domino. If that's the first domino falling, and it's just, it just runs through. And that's going to be the job of the government, and really, to a certain extent, the FCA and the regulatory bodies. It is their job to ensure that people have trust in the system. So you would like to think that there'll be interventions, like we've already spoken about, way before we get to that point where it would get that bad. You could nationalize the banking system, mate. You couldn't. You couldn't. So think of it this way, right? If you nationalize it, banks are private companies. They're publicly traded, but they're still owned by private individuals. So they're owned by their shareholders, pension funds, multitude of people. So if you said we're going to nationalize this bank, you essentially have to buy that bank. You have to buy the bank and bring it under national control. Where's the money going to come from that? And if you think about it, how many banks are there? There's 1,500 banks, building societies, insurers, investment houses. So let's just say out of the 1,500 banks specifically, you're probably looking, let's just say 200. But the market caps for some of these banks are what, 2-3 billion? Where's the money going to come from? So it's a really, really difficult thing to do, to nationalize banks, because you have to pay out the shareholders at the end of the day. You have to pay out the shareholders, because if you didn't, there will be an uproar. It's like the government. It's like, okay, so assume you own your house. Say your house is the bank, right? You own your house, and the bank says, we're taking your house. The first thing you're going to ask is, okay, fine, but you're going to pay me, right? If the government says, no, we're not paying you, how outraged are you going to feel? You'd fight it tooth and nail. Same thing. Identically the same thing, mate. Good question here. If the bank run happens, will bank stocks plummet, or does that depend on per bank? So if you see a run on the banks, typically, um, the stock the stock will plummet. I mean, a bank run can foreshadow the end of the bank. The bank is gone, done. The business disappears, um, and when that happens, it's jobs. There's a lot of fallout from it. So that's why you'll probably see the government intervene very, very early on. And governments typically do intervene very, very early on to try and stop that from happening. I thought this live was in 2 days. No, we're doing the one about the bank provider that doesn't have a limit on overpayments. We're doing that on Thursday, Kev. But today, yeah, we're just talking about this here. Arwin saying, are we really too scared to let the banks fail ever again? Have we capitulated that much? Mate, I think so. That's the sad reality, man. Like, if the banks failed, if we let a bank fail, the fallout is huge. The question is, would people be happy to bear the pain? And how far does the pain go? I think if you were to sit down with someone really like super clever, way cleverer than me, I'm not even sure that they'll be able to tell you how far and how much damage it would cause if you let one of the major banks fail. Because it is about pension funds, it's about businesses. And this is not just small businesses, these are multi-million pound businesses, all the way through to medium sized, to small businesses, to startups. Everything. You'll see business failures, you'll see job losses, you'll see housing losses. The property market will probably crash off the back of that. You've got to remember, some of these banks are huge in the property market and mortgage market. You'll see property market fail. The massive impact it's going to have on the economy, therefore the stock market. Mate, hypothetically, I would love to see what that scenario would look like, just to see how far that damage would go. But they won't. It's too big. The damage it would cause would be too much, too much. And like I said, what happens here is people have to deal with it. People have to deal with it, not the executives. People, and that's where the problem really lies. I don't know how people still trust the financial institutions with the fractional reserve system. Let them fail. There are alternative financial systems. Rest in peace over the plaster. Rip over the plaster. Look, what other financial systems would you allude to? I mean, you can probably put crypto in that bucket, but is crypto ready? I don't think it is, mate. I don't think crypto is ready for the volume. I think there needs to be a lot more done in the crypto space. But then again, I'm not a crypto expert, so I'm sure there'll be crypto heads who will be like, listen, Pete, they can do this, they can do that, they could do this. And I'd love to have that conversation. So if anybody does watch this or knows someone who's in the crypto space who could have a really intelligent and really insightful conversation with me on a live like this about crypto and how it might potentially replace, or how it could replace, the financial system, I would love to have that, because it will be something that I could learn about as well. And it would be very, very fascinating. I mean, I think if we fast forward 20, 40, maybe 50 years into the future, potentially, look, I don't see that the financial system will be as it is right now. I think there has to be a change. What we've got right now is unsustainable. It just doesn't work. It just doesn't work. I mean, our whole system needs an overhaul, not just the financial system, government, everything. You know, how we run the country needs an overhaul. It's just not working right now. You know, cutting bonuses would certainly help. Really, would it though? Bonuses for who is the question. Look, the way I see this is, if you think about the top guys in the banks, right? So you're probably thinking about the CEOs in that comment, right? So what bonuses are they getting? You know, that yeah, they're getting tens of millions, right? But if you compare that to the bonuses that are paid out across the board, like, so if you just said, like, so if you said for a bank, right, they have 10,000 employees and this is their bonus bill at the end of the year, I think when you compare it to the CEO, the top guys, what they get paid will still be a fraction of the overall bonus payment. And let me back up why I say that. I've worked at the high level of financial services in investments and all of that kind of stuff, where people make a lot of money. And trust me, I wasn't one of the top earners. These guys make So much money. It's eye-watering. It's stupid. So when you think about, right, there's him. Let's just say traders, for example, making £1 million a year. There might be 20 of them. There will be hundreds of them doing similar amounts, right? So when you aggregate all of the bonuses they pay to the employees, the staff, when you compare it to the CEO, it's still a fractional amount. So cutting the bonuses there, would it make a difference? No. I think it will make a difference when it comes to, I guess, public perception and maybe morale, perhaps. It will definitely make a difference there. But is that a tangible difference? I guess is the question. I don't know. Will it make difference to the people who work, who have to pay mortgages, who have to pay rent, who have to send their kids to school, who have to, survive? Is it going to make any difference to them if they did divvy up those bonuses for that one top guy in, Barclays, for example? Okay, divvy it up over how many employees? 20,000 employees. What does it actually do? It's a difficult one. And like I said, I see things differently because I have worked in the industry and I have like a healthy amount of trust, but also a healthy amount of distrust in what they do. It's not all rosy, believe me. I know that it's not. When we start talking about, the bonuses, I've also seen at that level, it's tough at that level, man. It's tough at that level, and some people don't necessarily appreciate how tough it can be a lot of the time. But like I said, my point of view on this is quite unique because of my career and because of what I've seen. And I'm not saying that it's right. I'm not, but I do see it in a different way, and it's great that we can have these kind of conversations, right? Why put money into savings account with inflation at 8.6%? You need to look at other investments, S&P 500 over the last few decades, 8%. At least you're standing still. That's true, but then you have the investment risk. In a savings account, you have no risk whatsoever. So that's the equation that you have to deal with there. There is no guarantee that the S&P 500 is going to do 8% this year. And there are so many variables within that. It's easy to say, yeah, the S&P 500 has done 8% every single year for the last 20 years. It's easy to say that, but you may not be invested for 20 years. If you're investing because you want to buy a house in 3 years' time, well, you're heavily dependent on that short window. So if you have a -10 this year, or -2 or -3 this year, and it goes into a global recession, and let's say for 3 years of the 5 you're in negative territory, but you have 2 good years, well, you could make 16% in the last 2 years, but you could be down 20%. So you've got a 4% net loss. There are so many variables that go into it. Understanding what your goal is, your timeline, the risk management, all that kind of stuff comes into the equation as well. And so it's not always about what the number says. Inflation is this, the potential return on this is this. It's not a guarantee. You still got to take the risk. Well, what else is told behind those numbers? What's the story behind those numbers? And when I was advising, these are the kind of stuff that we would try and unearth with clients to kind of really get a good understanding. Do you have the stomach? Do you have the time to be able to really look at this from an investor's point of view? What happens if, we have a -2? What do we change? So on and so forth. But it is a good point. There are lots of opportunities still at the moment with investing. But again, it is down to personal circumstances. Right, I'm just scanning. There are quite a lot of comments here, and we're 1 hour, 8 minutes in. Jesus Christ, guys. This is amazing. Seriously. There are so many comments here. I've literally had to scroll. I'm probably about 50. I'm at least 30 or 40 comments away from where I was right now. Probably even more than that. There's so many. Thank you so much for the engagement. I really, really do appreciate it. Thank you so much. Look, I'll be back again on Thursday. Talk a little bit about the overpayment thing. Like I said, I spoke to the provider today. There are some things that I've noted down. I'll take you through the website and all that kind of stuff, and try and make sense of what they've told me. Communicate that clearly. But I would encourage you, go find that the provider and speak to them directly, and mortgage brokers and all that kind of stuff. But I will cover that on Thursday because I think it is quite topical. I appreciate every single one of you. There are 105 of us, 107 of us still here. We've got 73 likes. It would mean the world to me if we can get that up to 90. That would be amazing. So it takes 1 second to do it. I'd really appreciate you helping out. And again, if you have watched this all the way to the end, I want to say a big thank you. I know I keep saying this, but it really does. It does make a huge difference. It makes this kind of like hour that I've spent with you worth the time. I enjoy doing this more so than filming, editing, and then uploading where I don't get any interaction whatsoever. So thank you. If you're watching this on replay, thank you so much for making it this far. If you haven't subscribed already, then consider subscribing. I try to make myself available. I'll probably do another finance clinic maybe on Sunday, depending where I am, but I will schedule it ahead of time. So just make sure that you hit the notification bell as well. So when I do schedule, you'll get the notification that we are doing that. So in the finance clinic, it's all about me answering questions and being as helpful as possible, bringing some of my experience to the table and trying to give you a little bit of perspective to help you make better financial decisions. Really, that's what it's all about. And again, we use it to interact. We use it to just have fun, really, and talk about money in a way that is lighthearted and hopefully relatable. But thank you so much. Whatever you're doing this evening, enjoy the rest of your evening. I've had so many people ask me about the song at the beginning, the intro, and at the end of this live stream. And I've been watching it the past few days. Even though I click on to the out screen where it says, thank you for watching, you guys still hang on for like the minute and 15 seconds to hear the full verse. And people have been asking me, is that you? Yes, it is me. I used to write music. I used to be a producer. This was a little bit of fun, probably about 18 months ago. And I finally thought, I'm just going to use it for this. I don't know whether people like it or not. Apparently you do like it. It isn't going to be released. I don't have the ability to release it, but the feedback I've been reading is very, very good. Thank you so much. It does take me back to my 20s when I used to do this properly. But it was an experience recording it as well. It's quite fun. It took me back. But hey, here it is. Enjoy.
Surprise, a little different than you're used to. Dropping these bars on YouTube, knowledge I introduce you. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck. We got the traders, got the picture with the Bentley in Dubai. Are you dripping in designer looking fly? On the bombardier, sipping on the wine. Broke man, we broke. Where's the fun in being broke? Stocks and bonds get you yo. That's what I'm teaching these folks. I see that smoke, see them choke. Getting coked while I'm researching these stocks. Buying coke. 20 months on the channel, million people taking note. I got a warrant for Buffet. I'm coming for his vote.